Hello, everyone. A jittery rand, sticky inflation, global elections, and a stock market that I would suggest defies logic on most days. So, how do you stay invested these days and also stay sane? A very warm welcome to The More You Know. It's a new podcast series from Stanlib Asset Management where smart thinking meets sharp timing. My name's Jeremy Maggs, and in every episode, we're going to discuss what's really moving markets and how do you stay ahead of the game and how do you think carefully about money. My guest today is Marius Oberholzer, head of multi-asset, and he's calling this the most exciting macro setup of his career. Wow, those are big words. And yet, he also says he's nervous. So let me link those two for you. What is a nervous bull? What does it mean? And when does data and all those conflicting signals come together? When everything is flashing red and green at the same time. And opportunity, and you're going to love this line, is tangled in uncertainty. Tangled in uncertainty. Marius, a very warm welcome to you. You're our very first guest. Tell me, what is a nervous bull? Are you pawing the ground with anxiety?
First of all, thanks for having me with a broadcast legend. It's nice to be sitting here with you.
Sorry, we're
Nervous bull. Yes, I'm definitely nervous. The old phrase that I heard when I was a young trader was like a cat on a hot tin roof. And I think we always like that in markets as market participants. But it's such a unique environment right now with so many different things going on. And the listeners will know that, right? They're experts, they're watching markets. The noise is unrelenting. We have an amazing personality in the President of the United States, Mr. Donald Trump, who's keeping us all excited and pulling our hair out. In your case, maybe not so much, but the rest of us are pulling our hair out.
Thank you, Marius. Just remember who's running this podcast. Yes, okay. 15, love 15, but fair enough. Yeah.
And we've got these big secular shifts happening, once in a lifetime shifts happening. Be it the way we work, be it the advent of the next wave of technological innovation, the political shifts, and this weaponization of financial markets and currencies. Geoeconomics is the phrase that I think the economists have used, and it makes people like me who've spent their lives investing in markets using top-down macro themes. It just makes it all so much more exciting than it's ever been.
So how does it compare to previous market cycles that you've traded in, or is this uncharted territory?
I think it's completely uncharted. I mean, there are always cycles, especially in emerging markets. You feel the cycles much more acutely. You know, emerging markets are sort of the mangy flea on the tail of the dog. And so when that tail wags, you really feel it. And the flow of capital matters in emerging markets. And the whole world's become an emerging market. And so I can compare it to sitting in China or sitting and investing in places like Vietnam or, South Africa to bring it closer to home. And that's how markets are now. So I think the flow of capital matters. What's nice for us is because we focus on the flow of capital, we're a little bit more in tune to this cycle relative to previous cycles. But I think that the secular shift is so much bigger this time than we've ever seen, that it's very different.
You talk about a secular or a structural shift. I'd suggest to you, though, that within those moving tectonic plates lies real opportunity. So are there macro signals right now that are giving you some degree of confidence?
I think it's always difficult to find confidence because markets change. And our entire process is set up with multiple things that we look at that I think gives me confidence that I'm not focusing on one thing that might not work, and that the markets have shifted and the market's not looking at that signal anymore. So we've got multiple signals. But the thing that I'm really focusing on, and we have probably for my entire career, but even more so in the last 10, 15 years or so, is really focusing on market liquidity. And when I say market liquidity, it's really around that flow of capital that I mentioned earlier that used to impact emerging markets so much, and now impacting all markets. And to a degree, we had it through quantitative easing, we had it through the fiscal response mechanisms in COVID, and we're still seeing that fiscal response play out. We're seeing taxation changes, we're seeing those political changes, but it affects the flow of capital and liquidity from central banks, from the credit cycle, from investors, from passive investors and the way they behave, and the change of behavior from investors. So we've got one person in our team that exclusively focuses on liquidity, both from quantitative signals as well as qualitative work that we do. And that in our team is what we're ranking the most important thing at the moment, is liquidity. And we've got hundreds of different signals that we look at in that world.
So how do you strategize around less liquidity?
If we think there's less liquidity, we get really defensive. So if I'm a cat on a hot tin roof, I'm going to get a parachute pretty quickly. And I'm going to get some water to cool down that roof. And I'm going to reduce the risk quite dramatically in my portfolios. And that liquidity, we think, is more important now than the economic indicators out there that traditionally, investors might look at. Kevin Lings helps us with that, and we still think
chief economist.
Yeah, exactly, and he's superb at what he does. But we think that the validity of the signals that economics used to give us has been dampened down by these extreme measures that we're seeing coming about in the world, and it's just a little slower than it used to be in terms of forecast and reliability.
So, Maurice, you spoke about consumer behavior. How is that changing to deal with those structural shifts, or to be more prosaic about it, to handle the cat on the hot tin roof?
Well, I think there are a couple of things. One is that information is in everyone's hands. My mum, close to 80, has got the same information that I've got. AI has put that in people's hands. Podcasts like this, the accessibility to information used to be an edge for asset managers like us. It's not accessibility anymore. It's how you process that information. And I think consumers now also have a really clear, easy route to market to invest their own capital. And I think COVID accelerated that. Retailers realized that there's a really easy way to potentially invest your capital, comes with risk. And we've seen the rise of passive, which on its own changes behavior. We're seeing one-day options in the United States in retail activity, the most active it's ever been, with huge amounts of capital trading on a single day's movement. Something the likes we've never seen before. India, options trading is enormous. South Korea, same thing. And I think that affects markets. It affects investors' behavior, consumers' behavior, and the signals that we as investors need to interpret on a daily basis.
So how do you hold steady with so many often conflicting data points?
I think, again, not relying on one. In the old days, you could rely on one or two or three. We've got hundreds of different signals that we're using. Also realizing and remaining quite humble about the fact that we're not the smartest guys. We don't know what's driving markets. And so we need to remain humble. So price tells us a lot. And if we're wrong, we move very quickly to cut that position, either because it's going down or we're not in a position and we don't have exposure to an asset class. But that asset class price movement will force us to reevaluate our behavior, as an example. But it's really around joining the multiple dots. Our entire process is set up on 6 major buckets of how we interpret signals. We've set up a team with quantitative and qualitative. We've set up a team that has long-term thinking blended with short-term thinking. Investors with traders, derivative strategy, foreign exchange. We've brought a whole team of what we think are differentiated skill sets versus the traditional way of building it by having a lot of people looking just at equities, for instance.
So what's the process then in driving a decision based on all of those data points? I mean, someone's got to be conducting the orchestra, right?
Yeah. It's not a black box. And the way to think about, or the way I think about it anyway, is we want to ensure that the airplane that can fly itself is still landed by a pilot when things go wrong. And ultimately that would be me. The buck stops with me, but I've surrounded myself with that team. But ultimately the portfolio managers will make those decisions. and within the risk confines that we set long ahead of time.
But you've got to be able to move a lot quicker these days than you did in the past, right?
Yes, and what we have found is we may be moving a little slower than we'd like to because our teams got bigger, etc. But you have to move, always be moving in markets because the risk is changing constantly and the information is changing, which changes the reward and changes the risk profile, and you need to adjust to that. That's what our clients are paying us for. Ultimately, they're not paying us to be the best in the room. They're paying us to control the risk in their portfolios so that they can stay the course and generate the returns that they need to over the long term.
You're listening to episode 1 of the More You Know, brought to you by Stanlib Asset Management. And today we're digging deep into why this market moment could be one of the most exciting and perhaps one of the most misunderstood of all time. So let's get back to that nervous bull, Marius Oberholzer. Let's continue the conversation. The role that monetary policy, both here and abroad, is playing in your decision making. How do you factor that in?
I think that monetary policy matters, but it matters less than people think. It mattered a lot in 2022 when we raised interest rates around the world at the fastest speed that we've ever had. And this will be, I suspect, if consensus is right, will be the first time that we kind of cut less than we raised in the last 30, 40 years. As we go into we're in the cutting cycle, but as we move through that cutting cycle. But the cutting of rates makes it easier for consumers. It makes it cheaper to borrow, and that's going to impact liquidity on the upside again. And it's going to bring the cost of capital down. So it matters. But I think the fiscal response mechanism, the willingness of governments to provide support to consumers, the likes of which we saw in COVID. Now they're talking about supporting corporates because of the tariff impact in places like Europe or Japan. And so there's this massive support mechanism behind corporates, behind individuals, which is putting government balance sheets at risk, but it really provides a massive tailwind. And so I think monetary policy is important, but it's less important than it has been in the past.
Let me pick up on a couple of other issues if I can. Let's focus on China very quickly and its current economic trajectory. How does all of that factor into your thinking right now?
It factors in predominantly, not so much from a growth perspective. I love the Chinese market. I live there. It's a weird place because it's so controlled by the Politburo, or more specifically, Premier Xi. Ultimately, China's economy will grow at north of 5% or around 5%, but they've got a demographic issue and they're busy having a asset bubble bust with their property market. And there's massive disinflation there, deflation if you like. And that is impacting the rest of the world. And of course, the tariff impact is going to adjust their policy that they have, where they've been export focused, to be much more domestically orientated. They have been for a while, but they have to get consumer confidence up. They have to get the animal spirits of spending up. Chinese are a very savings-driven people, and they like safety. Their entire notion is around safety, and safe as houses, for instance. They're not willing to just take risk. They will, when the time's right, but I think there's a lot of reparation that needs to happen there. So I think the growth aspect is a big one, but it's not the likes of which we saw previously. And Chinese growth doesn't always manifest in returns for investors. We've seen that. Fantastic GDP growth over many years. Equity markets haven't done a lot. They've gone up and down a lot, but they haven't paid investors the way the United States market or the South African equity markets have paid.
Marius, I'm glad you mentioned the tariffs. It's probably going to be the word of the year, I would imagine, come the end of 2025. How worried are you?
We came into the year feeling pretty positive about the world, and predominantly when we war roomed President Trump's election outcome, pre the election in the United States. We knew he was running on three main kind of policies. One was tariffs, one was tax cuts, and the other was deregulation. And we felt that those three together were going to be pretty positive. And I think we talked about it in the early part of the year. And what we got wrong was the sequencing. And so tariff being announced on its own, the chaotic announcement and that we got in April. And that upset markets. It certainly upset us.
I mean, difficult to war game the uncertainty and the rhetoric around that, right?
Yeah, and just the chaotic nature of the announcement and as aggressive as it was. And that worried markets. But, you know, you lose a lot of sleep worrying. The uncertainty's gone. They've announced the tariffs. The negotiations are happening. Markets fell. He realized that he would maybe be in a bit aggressive. Scott Bessent has done a phenomenal job in shoring up confidence, and I think the markets have now absorbed it. They've brought it into their thinking, and we'll adjust. Markets have made highs post those April sell-offs, and I think that April sell-off was warranted. And I think what we're seeing now is warranted. We probably are where we are in equity markets, where we thought we'd be. It just was a little bit more of a chaotic way of getting there. So I'm not too worried because I think there's more certainty around it now.
Are you projecting then or thinking about more strength in US equity markets?
Certainly our team is. We do think there's strength in in US equity markets. We think there's probably strength in global equity markets. I think I've been amazed at the strength in the European equity markets because simply I understand why people got excited about Europe. They pulled, there's major change there as well. But the strength of the currency in Europe is going to hurt their earnings. But I think ultimately there's much more certainty around the trajectory of the Trump policies. And I don't think they're all bad. I don't necessarily think they're great for society and free trade and all the things that we've had since the Second World War. That's all being disrupted. But as an investor, I think it's a fantastic opportunity to maintain exposure to equities broadly and maintain exposure to the United States. It's innovative, it's rewarding, the rule of law is strong. They've got phenomenal investments, and their companies are not expensive, even though you will have all the doomsayers tell you that the markets are expensive.
And noteworthy within that trend are tech stocks.
Correct. And not just tech stocks. I think tech stocks are obviously a fantastic place to be. They are expensive. They are part of that secular change that I talked about earlier. But the way of working is changing. We can feel it in our business. We're making great strides in artificial intelligence and all the other innovative technology around that. Which means that we're becoming much more efficient at how we work. And I'll just use that as an example. And you pivot into corporates in the United States and around the world, and the earnings are going up. And the efficiencies that they are starting to show because of embracing technology is going to show up in the margins for these companies. And that is going to continue to drive the valuations upwards. And it's exploding outside of just tech into manufacturing. Into other service industries. And so AI it's not just a tech story, it's the tech enablement that drives margins and therefore valuations and therefore cash flows to investors. And I think I've got two examples. You know, if you're running around a track, 400 meters takes you, let's say it takes you 60 seconds to get around an athletics track. What AI gives you is the ability to climb on a bicycle and get around that track much faster. And I'm stealing that from somebody who gave me that analogy. And that's going to mean, I really think it's going to change the way we work dramatically. And that's one of the main reasons I'm so positive. But I do think earnings are going to continue to surprise us on the upside. And then I think the other component, using President Donald Trump's kind of policy around deregulation, is going to be a real driving change in the way people do business. And if you allow entrepreneurs the ability to move quickly, to cut the red tape, and something our government, I wish they'd learn, it's going to be much easier to drive productivity, to bring new products, to bring new innovation, and it's going to drive earnings.
A quick view on the commodity super cycle. How are you reading this? Is it a real push or just a blip?
Yeah, I don't know where the super cycle came from. I mean, I don't think it's a super cycle. I don't think we've got any indication that it's a super cycle at all.
It's running pretty hot at the moment.
Yeah, but commodities are volatile. And I think commodities are telling you something around some of the things I was talking about, that it's not all doom and gloom. Don't believe all the naysayers out there. There are lots of reasons to be concerned, but there are a lot of signals telling you that things are okay. But not all commodities have run as hard, right? We've had gold platinum, precious metals specifically. There are other things that are running. But I don't think it's a commodity super cycle. I think it's too early to suggest that. What I do think is going to happen is the infrastructure build out around the use of technology that we talked about is going to require a lot of commodity. And we've got a supply constraint around the world, given what we've been through over the last 10 or 15 years. And so there is probably a nice tailwind for commodities, but I don't think it could be classified as super cycle. I would fully expect platinum to come under a bit of pressure quite soon, which has driven our equity market in the last few weeks.
So, Marius, in conclusion then, we've spoken about a lot of stuff. We've spoken about cats on hot tin roofs, we've reflected on China, but as we draw to the end of this discussion then, is there an insight or perhaps a mindset that our listeners and viewers need to start thinking about right now? Where should their headspace be?
I think it's a great question, and I hate to almost hate to say it because it's cliched, but think about the long term. There are big positive things happening. There's a lot of noise. There are a lot of negative things. There are a lot of things to worry about. That's our job. Our job. That's what we get paid for, is to worry about these things. I think focus on the positives. I heard a phrase from my younger brother once. He said, there's always lots of reasons to not do something. Don't miss the one reason to do something. And with that, I think, know that this is a once in a lifetime type of secular shift that's happening, and be invested. I think be invested, stay the course with your investment plan. Don't get shaken out of that investment plan that you've got for yourself, that you and your advisor have come up with.
So we started this conversation with me calling you a nervous bull. Is it a nervous bull or a hesitant bull?
Probably a bit of both. So growing up in a hedge fund, it's always been about protecting capital, which made me probably a very cautious thinker about markets. And I find myself to be way more bullish than most in my team, which doesn't happen often. And I'm talking about over the last 2-3 years or so. And so I am a bull, but I am absolutely a nervous bull. But I would say hesitant because I don't find myself this constructive on markets this often. In fact, I don't think I've ever been this constructive longer term on asset markets ever in my career.
What a brilliant conversation. Thank you very much indeed. That was Marius Oberholzer. I think helping us separate the noise from the signals in a market that is really, as we've been discussing, bursting with contradictions. But within those contradictions, within those structural faults that he was talking about, lies real opportunity. So that's it for episode 1. Join us next time on The More You Know, where I think it's fair to say clarity is the best investment that you can make. Bye-bye, everybody. Stanlib Asset Management Pty Limited is an authorized financial services provider in terms of the FASE Act. This content should not be construed as advice.